and you have a large wealth and values gap and political gaps, you tend to have fighting, internal conflict. And so rising internal conflict about how to divide the wealth pie is very, very normal historically.
According to Ray Dalio, most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it. In 1945, we began a new world order. In 1944, we created a new monetary system, the Bretton Woods monetary system, and then we created that new world order. And that created bull markets and stocks and American world order for the most part. There's a cycle that we're used to, in which whenever you have an economic downturn, the central bank hits the gas and can create debt expansion. And that produces an increase in demand. Before proceeding further in the video, please like and share the video, subscribe to this channel, and click the bell icon for more updates. And that happens in 3 phases of the cycle. Normally it's interest rates, you lower interest rates, and the economy turns up. But when you hit zero interest rates, which happened in the 1932 debt crisis 1932, we hit zero interest rates. Then you go to the second type of monetary policy in which central banks print money and buy financial assets. To add liquidity in those purchases, those sellers of bonds who get the cash go out and buy other financial assets, and we have the process going through, and that's the second type of monetary policy. So the only 2 times that happened were 2008 to 2009 to 1929 to 1932 zero interest rates print money monetization. That'll carry you so far, and then there's what I call monetary policy 3, which means that money does not trickle down to the population and go all the places it's needed to go. In other words, the coordination between fiscal and monetary policy, so that the central bank is buying assets of a different sort, a wide range of assets producing liquidity, and also having the effect of buying government debt and monetizing it. And that's the late cycle of an expansion. That's what's driving the markets now. That's what's driving the economy now. For example, today, the Federal Reserve and the government create the liquidity we see in the markets. And it has big implications for the value of money. What is the value? Where does the money go? Cash will be a poor investment, so that's the character of the environment, which means that if you look at the returns of asset classes and you take cash, isn't it an interesting world? When do you have zero or negative interest rates? And then there's the desire to create a spread, so the short-term rates are lower than long-term rates, and there's so much liquidity. The central bank is making that market, so when we look at the market today, it needs the store hold of wealth, and you see it reflected in all asset classes. So that's the main driver, and it also has very big geopolitical implications. Because as we come into this environment where we have the second influence, the wealth gap, the political gap, it means that the distinction of how money and the bills will be divided, and how that will affect tax policy and the like will matter a lot. I think it's very much like the 1930s, which means it doesn't produce a general level of inflation immediately. It negates deflationary pressures, and it produces currency depreciation over some time. In the 1930s, all currencies in the early 30s depreciated in a relationship at that time. Concerning gold, we see the same kind of thing happening without a general level of inflation, not just gold. It goes into other strongholds of wealth and stock, particularly certain stocks. So very much the same as 1933. In the 1933 March of 1933, Franklin Roosevelt severed the connection with gold-printed money and made money available, and that was the exact bottom in the stock market, very similar. On April 9th, the Federal Reserve and the Treasury did the same thing. So that goes into other assets such as stocks, crates, or reflation. It must be done because the consequences of not doing it are unacceptable. With the wealth gap and so on, we're in a situation where every individual, every company, every government has a certain amount of revenue, a certain amount of expenses, and a certain balance sheet. And when the revenue goes down to below or inadequate relative to the expenses, and there's no adequate balance sheet, then defaults and restructurings occur. That's true for the population as a whole. And that's true for several businesses, hence the policies we're seeing. What has been true in history is that when you have an economic downturn, that's a serious economic downturn and less effective monetary policies at that same time. But the interesting thing about that is when you look about when interest rates, let's say bonds, approach a zero expected return, their ability to go up in value or interest rates to go down is limited or impact. One has to leverage those a lot. And that's not desirable, but through history, I studied the last 500 years of cycles going back to the Dutch cycle in terms of the Bank of Amsterdam, and that whole cycle. In all cases, central banks will print and devalue money when they get in that course. The basic problem of depression is a debt liquidity problem. And so always through history, the choice will be reflation even when you hit interest rates in the way we're seeing now. And so, to understand that the nature of the diversifying asset has shifted to be of the sort that I'm describing in terms of other assets that at that particular time benefit from reflation because it will be reflated or die. And so we will always see relation. And that's why in history, you see that all currencies have devalued or died over some time. Particularly in such periods, we're in a new paradigm. Please don't wait to ask in your comments section if you have any other queries. Thanks for watching. See you in the next video. Please like and share the video, subscribe to this channel, and click the bell icon for more updates.